Learning objective number 3 regards pro forma financial statements. How do we build them and the project cash flows that result from them? So essentially, again, we're going to do these in order. First, we're going to build and set up a one-page sheet of assumptions for each of these statements, especially the first two. I'm going to have a one-page income statement and a one-page set of assumptions to go with it, and then a one-page balance sheet and a one-page set of assumptions, and from those two will fall out a statement of cash flows. Again, we're probably going to do these for 5 years in most cases, and we're interested in cash flows ultimately. Let's do a sample project here. Let's say we want to build and start up a shark attractant project, which will cost us $90,000 in investment. We're going to build a small shed, and we're going to put some equipment, so we're going to have some property, plant, and equipment in there, and we're going to depreciate it at a rate of a straight line to zero over 3 years, and then we're going to close this project down. So picture this project going on for 3 years. From that, we're going to need to do an income statement, quick balance sheet, and cash flow. Make some projections and some assumptions. As I said, one-page sheet of assumptions, one-page income statement. We're going to project that this shark attractant product can sell 50,000 units at $4 a unit, giving us sales of 200,000. The variable cost will be $2.50 a unit. $2.50 a unit times 50,000 units is $125,000 in variable cost. The contribution margin, which we calculate to see if we have coverage of our fixed costs, a very important calculation. Sales minus variable cost equals contribution margin. Our author doesn't include that in the book, so you want to put those words in your book in that little income statement under variable cost. Sales minus variable cost equals contribution margin of $75,000. It does indeed cover our fixed cost of $12,000, so we're going to go ahead with the project. Depreciation will be $90,000 on the property, plant, and equipment divided by 3 years, straight line to zero, $30,000 per year on the of depreciation expense on the income statement, leaving us with EBIT of $33,000, taxes at 34% or $11,220, leaving us with net income of $21,780. From this, we can quickly do an OCF, EBIT plus D minus T. So we would take $33,000, add back depreciation because it's a non-cash expense. We're trying to calculate cash flows. So plus $30,000 minus $11,220 will give us our cash flow that we need to calculate. We also need to look at net working capital, and we also need to, which will be $20,000 negative at time zero to start this project, again for current assets less current liabilities. And net fixed assets will build a little balance sheet like you see here in table 10.2, which will show the gross fixed assets of $90,000 each year. Today it's $90,000. End of year 1, the gross fixed assets are $90,000. End of year 2, still $90,000. End of year 3, still $90,000. Then you see the accumulating depreciation, $30,000, $60,000, and $90,000 by the end of year 3. And you'll see your net fixed assets going down from $90,000 today to zero by the end of year 3. Again, we'll calculate the operating cash flow, OCF minus CFFA, will be OCF minus NCS minus CNWC. And we get that OCF by building a full vertical income statement as we've done on a prior slide. So always build your income statement all the way down to NPAT so we can calculate OCF several different ways. So here's our income statement again that we projected. The cash flow will be $51,780 because it's EBIT of $33,000 plus D of $30,000, which I add back in because it's a non-cash expense, minus taxes of $11,220 to get OCF of $51,780. Now I will get this $51,780 in each year for 3 years because it's a 3-year project. Then we're going to close it down. We will have working capital negative at time zero, and then we'll recapture that working capital at the end of the 3rd year by selling off the remaining shark attractant product and knocking on doors and collecting our accounts receivable. So we do a little OCF table, OCF of $51,780 for each of the 3 years we're going to run this project. We have negative net working capital of $20,000 today, negative property, plant, and equipment cost of $90,000. That's again for the little shell we're going to build, the building, and also the grinding equipment we're going to put inside the building. And our total project cost today is $110,000. For that, we'll get $51,780 in, $51,780 in, $51,780 in, in the third year plus recapture of our working capital. We'll change that working capital sign to plus 20,000, and we'll get 71,780 in year 3. And again, I can use all of those analyses we did in session number 9 on these cash flows. So I can do an MPV. I just find out the discount rate from the CFO, and I can do an MPV on this project. I can do a payback period. The question is, do we pay the CFO back in year 1? No. Do we pay the CFO back in year 2, her $110,000? No. Sometime before, during year 3, we pay her back. So if she has a less than 3-year payback period, this project will qualify. And then we're also going to do the IRR on this one. We would do that by taking MPV equals 0 equals minus 110,000 plus 51,780 over 1 plus R, plus 51,780 over 1 plus R squared, plus 71,780 over 1 plus R cubed. Calculate the rate at which your cash, discounted cash inflows equals your cash outflow of $110,000. We want to look at, include changes in net working capital in our analyses. So just not the pure sales number. Sales won't generate pure cash income. We must look at and take out the increase in accounts receivable. And from cash costs, we must subtract increases in accounts payable. And again, this is just following our OCF minus NCS minus CNWC methodology. Here's an example, 10.1, Combat Wombat Telesat has sales of $998, cost of $734, and you have some working capital involved, beginning and ending balance sheet. So from this, you see that your accounts receivable went up 10, your inventory went down 20, and your accounts payable went down 30. And so what is the cash inflow, the true cash inflow? What's the true cash outflow? And what is the net cash flow? Again, net cash flow will be CFFA, OCF minus NCS minus CNWC. So cash sales were $998, but receivables went up by 10, so we didn't collect that cash. So we would post our cash sales as $988. Costs were $734, but inventories went down. So we didn't replace $20 of inventory, so costs were actually overstated by that amount. So we will take out that 20. And payables went down by 30. And we actually paid our suppliers $30 more than we received, resulting in $30 understatement of cost. So my cash costs are $734 minus the 20 of inventory that we didn't replace, plus the 30 of cost based on payables. So we get a cash cost of $744, and our net cash flow is $988 of net sales, net cash sales, minus $744 of net cash cost, or $244 overall. Net working capital went up $20. We can also, again, do the same thing by doing OCF minus NCS minus CNWC, and that's exactly what we just did on that slide. Depreciation is a concern. It's a good thing in that it's a non-cash expense, and it reduces our taxable income, so therefore it's a tax shield. So to the degree we can accelerate our depreciation, we want to do that legally, ethically, and morally in accordance with IRS guidelines. So a MACRS, you may hear in your accounting class, an advanced accounting class, is another method of calculating your depreciation. The IRS allows this. It's a little bit accelerated method of getting a little bit more depreciation in the early years so that you can reduce your taxable income even more. So you'll see methods like straight line depreciation, sum of years digits, double declining balance, and then this newer one, MACRS. Let's see how we do it. Every asset gets thrown into an asset class by the IRS, and then the IRS will provide you with a depreciation table. And I just simply take the percentage of depreciation times the cost of the asset, and it will all work out to 100% fully depreciated if you've done your mathematics correctly. Some examples, so the IRS will give you a 3-year class, and our research equipment goes into that, a 5-year class for autos and computers, and a 7-year class for most other industrial equipment, and they have other years tables for property, plant, and equipment that you can depreciate. So we'll stick with the 3, 5, and 7 simple examples. Here's the IRS tables for the 3 years. So basically you take 33 1/3% and depreciate the first year, 44.44. So you get a little bit more in that second year versus straight line, which would just be 33 1/3 each year. and then a little bit in year 3 and a little bit even in year 4. So a 3-year depreciation class goes for 4 years, a 5-year depreciation class goes for 6 years, and a 7-year depreciation class, actually you get some depreciation each year for 8 years. So this is the MACRS model, so know how to do this, and you can tell if you've done it correctly because your project should be fully depreciated, your property, plant, and equipment or asset should be fully depreciated if you've done your mathematics correctly. Don't forget that book and market are different, so you may sell a piece of equipment after the project is concluded, and you may get something for that, some money for that, even though it's fully depreciated. In that case, you have a gain, and Uncle Sam will want some tax on that gain. If you sell it for less than book, you may have a loss for tax purposes. Here's an example of how to do the MACRS. This is a 5-year class, $12,000 cost of equipment. So the first year I take the proper percentage times, which is 20% times 12,000, I get depreciation of 2,400, and so on. You just multiply the percentage in the table times the cost of the equipment, and each year you get your depreciation amount. Those depreciation amounts should add up to $12,000 if you've done your mathematics correctly, and the thing should be fully depreciated and have an ending book value of 0 at the end of the 6th year in the 5-year class. So you can test your mathematics 2 ways there and make sure you've done your math correctly. Here's an example of a company, Staple Supply, that just installed a new computerized information system, cost of $160,000, 5-year straight line to 0, no, 5-year depreciation, 5-year property. We're going to do the MACRS instead of this. What are the yearly depreciation allowances? Do MACRS instead of straight line. Based on historical experience, if we can get $10,000 when we get rid of it in 4 years, what are the tax consequences, and what's the total after-tax cash flow? Since we're using MACRS, we get the 5-year table, pull it out, 20% the first year, 32% the second year, and so on down the table, and all the MACRS percentages add up to 100%, and then we just simply multiply those percentages times the cost of the equipment, and if I add up all my depreciation amounts, they should add up to $160,000, and they do, and my ending book value will zigzag and wind down to 0. And the question is, what happens if I sell that piece of equipment in year 4? The book value is $27,648 from our table. If we sell for $10,000, we have a loss, in that case, of $17,648 for tax purposes, and so we get a little bit of benefit from the IRS in this case, and I save on our taxes of 34% times $17,648 of loss, and I get $6,000 back in taxes, so I'll have a $16,000 positive cash flow in that case.